Welcome to The Explainer. Okay, let's dive right into a topic that hits home for thousands of military retirees. Taxes. It's a surprisingly complicated world, a world where the federal rules say one thing, but then the states, well, they're playing a completely different ballgame. We're going to break it all down piece by piece so you know exactly where you stand for the 2025 and 2026 tax years. Here's how we're going to tackle this. We'll start with the big picture, the federal baseline that applies to everyone. Then we're going to zoom in on the nitty-gritty of your tax forms. After that, we'll look at a really fascinating court case that completely changed the game in one state. And finally, we'll pan out to the state-by-state map, which is where things get really interesting and could save you a ton of money. All right, let's start at the top with Uncle Sam. Before we can even begin to talk about state-level breaks and exemptions, you've got to understand the fundamental federal rules. Seriously, think of this as the foundation of the house. Everything else we build today rests on this. Now, this might look like some dry legal jargon, but for tax purposes, this is a huge deal. The Supreme Court decided that military retired pay is reduced compensation for reduced services. It's not a pension for work you did. Why does that matter? Well, because the IRS looks at that and says, aha, that's current pay. And that means it falls under Internal Revenue Code Section 61 as gross income. And you know what that means? It's fully taxable. Here's another way to think about it. With something like a 401k, you're often putting your own already taxed cash in, right? That's your cost basis. So when you take it out later, you don't get taxed on that part again. But your military pension? That's different. It's what's called a non-contributory plan. You didn't put after-tax dollars into it, so you have zero cost basis. And that's exactly why the feds tax the entire thing. Let's take a little trip back in time. For the very few retirees who actually did have some kind of cost basis, there used to be this great little perk called the 3-year rule. It let you get that money back, tax-free, in your first 3 years of retirement. It was fantastic. But then, boom, the Tax Reform Act of 1986 came along and completely wiped it out, spreading that benefit over your entire life expectancy instead. It was a major shift that took a big short-term benefit off the table. Okay, let's talk about the single most important piece of paper you're going to get in the mail each year, your Form 1099-R. This is where the rubber meets the road. It's how all those federal rules we just talked about actually get applied to your money. When that 1099-R arrives, I want you to go straight to box 7. Seriously, this one little number in one little box, it tells the IRS the whole story. It signals everything they need to know about what kind of retirement pay you're getting, and it dictates how it gets taxed right off the bat. So here are the big 3 codes you're going to run into. Code 7 is the most common one. That's for your standard 20-plus year retirement. It's a green light to the IRS that says fully taxable. Code 4 is for survivor benefit plan payments, which are taxable to the beneficiary. And then there's Code 3 for disability retirement. Each one of these triggers a totally different set of rules. And this is where things get really, really specific. I mean, it's one of the strangest quirks in the entire tax code. For a disability retiree with a Code 3, the taxability can hinge on a single specific date, September 24th, 1975. This comes straight from IRC Section 104A4. If you were in the service on or before that date, your disability retirement is generally tax-free. Joined after? Well, it's only tax-free if your disability was combat-related. It's an incredibly precise rule with massive financial consequences. So we've got the federal rules locked in. But what happens when a state just decides to do its own thing? That's exactly what happened in North Carolina. And it led to this landmark court case, one that wasn't decided by politicians but by judges, and it literally created a brand new class of tax-free retirees. So how in the world did a single lawsuit end up creating this special, permanent, tax-free group of retirees? Well, it all kicked off with a Supreme Court case way back in 1989 called Davis versus Michigan. And the court's ruling was simple but incredibly powerful. States cannot play favorites. They have to tax their own government retirees the same way they tax federal retirees. That one decision set off a chain reaction nobody saw coming. So check this out. North Carolina gets this ruling, and they have a choice: stop taxing federal retirees or start taxing their own state and local folks. They chose to tax their own. But the state retirees weren't having it. They sued in a case called Bailey versus North Carolina, and they won. The court said their tax-free pensions were part of their contract, and because of that earlier Supreme Court ruling, that tax-free status had to be extended to federal and military retirees too. Wild, right? And this is the absolute key, the million-dollar detail, right? It wasn't about when you retired. It was all about whether you were vested in the system by one specific date, August 12th, 1989. For them, vested meant you had 5 years of service logged. If you hit that mark, you were in. Your pension is tax-free in North Carolina under the Bailey settlement forever. It created this very exclusive club. Now, I know what some of you are thinking. Wait, didn't North Carolina pass a law in 2021 making all military pensions tax-free anyway? And you're right, they did. But the Bailey settlement is still a huge deal, especially if you're a federal civil service retiree. For many of them, Bailey is the only way they get that tax break. So if you're someone with both a military and a Fed civil service career, this distinction is absolutely critical. Okay, so let's pull back from North Carolina and look at the whole map. Because what's happening out there is basically a giant competition. States are fighting to attract military retirees. And you know what the main battleground is? State income taxes. I mean, just look at this chart. The trend is so clear you can't miss it. It's a race to zero. A whopping 41 jurisdictions now offer a full 100% tax exemption for military retirement pay. Only a handful are left with partial or complicated rules, and just one still taxes it completely. This is a deliberate strategy by states to get veterans and their families to move there. And here's just a sampling, and I mean a sampling, of the states that have said, you know what, we're not taxing this, period. The full list is much longer, and it seems to get bigger every year. And as you can see, this isn't just a red state or blue state thing, it's happening all across the country. This right here is a perfect example of why you have to read the fine print. You've got a state like Indiana that's all in, a full 100% deduction. Simple and clean. Then you have a state like Virginia, which is getting there, but it's not a full exemption yet. For the 2025 tax year, they'll let you exempt a first $40,000. It's a significant benefit for sure, but it's not a complete exemption. And now we get to the states where things get a little complicated, where they have some, let's call them creative rules. California's new break depends entirely on your total income. In Georgia, it's based on how old you are. Oregon's is bizarrely tied to service before 1991, and Montana, well, they have a rule so specific for working new residents that you'd probably need a CPA to figure it out. The bottom line, do your homework before you pack the moving truck. So after all these legislative changes and states competing against each other, who's the last holdout? The one and only jurisdiction that still fully taxes military retirement pay with no specific relief at all? Well, it's not a state. It's the District of Columbia. As of now, D.C. is the last one standing. So let's just quickly recap the big points here. Number 1, federally, your pension is taxable income. No way around it. Number 2, that little code in box 7 of your 1099-R is your new best friend or worst enemy because it dictates everything. Number 3, weird one-off court cases like Bailey can create special rules that last for decades. And finally, number 4, the most important takeaway for your financial future, the states are in a race to zero, and most of them have already crossed the finish line. This really leaves us with one big question, doesn't it? As states keep trying to one-up each other to attract veterans, the pressure is only going to mount on those last few holdouts. It's a huge win for military retirees, no doubt about it. But it makes you wonder, which state or district will be the absolute last to get on board?